Welcome to the ASIS Economist Board, where we discuss the current economic environment as it relates to industrial production. Each of our industrial production models incorporates data from approximately 18 to 20 economic indices, and our data goes back over 20 years. In this video and in the 7 related subsector videos, we're going to dive into what's driving these models and related to what we're seeing in the real world, and more importantly, where we see things are going and why. I'm John Nelson from M&A, and I'm joined today by Keith Prather. How you doing today, Keith?
I'm doing fantastic. I'm excited about this. Let's go.
Okay, super. So let's get diving in right into industrial production. And I'm going to bring up our first model. There we go. Okay, so Keith, what I've been seeing in the models is that you've got this softening that you see where before you saw the softening in the November model, but now you're seeing it soften, but a lot less. So if I can bring up my little annotator here, you kind of saw it with a little bit deeper previously. Now it's a little flatter all along the curve, but still not as strong as what we had seen a few months ago. Well, what I see in the models is a case of where a lot of the inventories are kind of playing in and exerting pressure on the models. So what's going on in the real world?
Yeah, it's kind of interesting, John, because when we first saw this model, I know as you and I looked at it, we were a little bit concerned about the dip in the curve, because that's not the narrative that we hear, at least publicly. But there's something that you probably saw my face go a little bit serious for a minute. There is kind of a developing situation that we have coming out of China right now, and I know that China is only a portion of the manufacturing story, because I know there are a lot of U.S. domestic producers now that are making 100% of their products domestically sourced, and so they're not as affected by this. But we've got another critical situation developing in China. There's more than 14 cities now, major cities, that have gone back into lockdown because of Omicron risk. President Xi is really trying to keep a handle on COVID as the country gets ready for the Olympics, puts them on the world stage, makes it very critical that they're not in the middle of a crisis. And so as a result, he's continued to keep a zero COVID case policy. And that zero case policy really is forcing them to do some very draconian type lockdown measures. So anyway, what it's done is it has started to shut down or started to really inhibit inland distribution. And so manufacturers, even if they can get their workers to work, and even if they can produce products, they're having a really difficult time, once again, getting it from their assembly lines to the ports for export. We know that a number of crews that were used in what we call short sea shipping, basically what they do is they move containers on small ships between smaller ports. They move them to larger ports where they're joined with other containers, and then they hit the big transocean vessels moving across the Pacific into the US. And we know that those short sea shipping crews have been quarantined because of Omicron. And I keep saying Omicron, I got to back up, but Omicron is just one piece of it, and Delta is still out there, and that's probably the bigger risk. But anyway, bottom line is that the inland distribution part of it is starting to shut down. So we have 2 of the major ports in China, Ningbo and Shanghai, both in the top 5 of largest ports in the world, that are now seeing significant congestion. All the shipping lines are now warning shippers that if they do have cargoes that they're expecting, that they're going to start seeing further delays. Right now, when we look at the West Coast, we've got about another 100 ships right now backed up off the West Coast. What the Biden administration did is they basically tried to move ships away from anchoring off the coast. And so the ports of LA and Long Beach have now been able to give ships that are leaving China a queue, almost like a reservation for a berth at one of the ports. So when they leave China, they kind of have an idea of how long the transit across the ocean needs to be, and they can do what we call slow steam. So they can adjust their transit time so that they're hitting the port at about the time they're going to be able to take over a berth. So what that does, though, is it just moves the congestion immediately off the port, off the coast, and stretches it out over the Pacific. So if a normal transit time is 4 or 5 weeks for cargo, right now we're seeing an additional 21 days being added to basically the unloading process.
Mhm.
So this, John, really equates to exactly what we saw happening last summer when the ports of Ningbo shut down again in July, and then that extension, that congestion, that supply chain backlog backed up well into Q4, and we're kind of in that scenario again, unfortunately. Um, so it's fascinating to me that the model or the curve is actually picking up a little bit of this deceleration, or, you know, like you said, it's kind of a flattening, but also a little more of a deceleration in the curve. And a lot of it tied to just supply chain challenges and still trying to get those products inland. So I do believe on the positive side, I do think that some of the domestic manufacturers have been able to get their supply chains a little bit back into cycle a little better
Mhm.
than maybe those are relying on some foreign sourcing. And so I think we do see more output, and it's also kind of what the model's reflecting right now. But it's a developing situation. I really do believe, and we're getting data day by day. And so it's evolving, it's changing, it's morphing, and we will be sending briefs out to members kind of regarding the situation. We're going to try and keep everyone abreast of what's happening over the next couple of weeks.
I remember last year, actually about a year and a half ago, when we were talking about the models and putting the things out, we said the story's COVID.
Yeah.
And that's the way things are going. And then we kind of changed the tune. The story is inventories. And it sounds like the story is going to continue to be inventories and how they are managed, at least for the 6-9 months.
Yeah, and you know what's interesting about these curves? So if we look at the model and we look at that cone of variability there, you look at the upper dotted line, you know, that's probably where the curve should be based on demand, because the demand side of this industry is still incredibly strong. You
Yeah.
and I have talked about it, and over the next 7 recordings that we're going to do in the 7 subsectors, yeah, demand for each of the products in this durable goods industry, if you will, is really strong and going to continue to be strong throughout 22, well into probably 2023. It's just this measures output, and because of that, the supply side is also part of the equation, and it's the supply side that's really kind of restraining it and keeping it flatter than what we think it should be. So it's just something to keep in mind.
So at the risk of playing stump the chump, and at the risk of extending this video longer than what we intended, I'm going to ask a question. I was reading something today that said, there's been a lot of pressure on, or a lot of emphasis on, American consumers buying goods, and yet what it's projected over the next 3 to 6 months, that the amount of goods that we're going to buy is going to start to taper off. We're going to start switching back over to services. What's your take on that, and how do you think that might play out in the models and the forecasts?
Yeah, you know, it's kind of interesting because a lot of companies right now, so there's the business to business side of the world, and then the business to consumer side of the world. The business to business side, if you're a wholesaler and you're waiting on, or like let's say like you're an automotive dealer and you're waiting on automotive manufacturers to be able to provide vehicles for you, you know, right now, if this is baseline inventories, right now you're sitting well below the waterline. And so the manufacturing side of things has got to build inventories up to a point where we just get to break even. Then they can start to build additional inventories. And that's happening across all these sectors. So even if the consumer starts to fall off a little bit, the business to business side of the world is going to continue to build inventories to get them rebuilt to levels that they consider to be just in case, right? You're hearing that term a lot.
Sure.
The consumer side, though, it's kind of interesting because we've now been in a pattern where, you know, we've been without the services side of the industry for so long that I think the product consumption side of this economy continues to extend just based on consumer behavior. But the one limiting factor that I think we all have to really now start to pay attention to is the impact of inflation.
Hmm.
And I do think the impact of inflation now is starting to weigh on, especially the percentage of families that are kind of considered to be a little lower middle class, and then you know, lower income families.
And I read it's at a 40-year high right now
Yeah,
for the U.S. 40-year
yeah.
high. That's pretty incredible.
Even when you strip out food and fuel, you know, rates were higher than they've been since 1991. So, you know, just it's just high all over the place. And now, as you know, I mean, we've both probably been to the grocery store lately, and you know, Omicron is doing weird things to the ability to get products on shelves. And
Yeah.
Just absenteeism now is super high. We're seeing 20 and 25% absentee rates at a minimum across most industries. We're hearing some as high as 50% right now. So even if it's a short window, we're talking about just a short period of time here for people to go into quarantine, which is now about a week. Used to be 2 weeks. Now we're talking about a week for most folks. We're still talking about a rough 3 or 4 weeks ahead of us where absenteeism is going to be high, and it's just difficult for companies to get shelves stocked, even if inventory is available. So,
Yeah.
But the supply chain on a whole, we'll talk a little bit about trucking, but right now we're seeing what we call load to truck ratios in the trucking sector. So load to truck ratio is just the number of loads for every available truck. Right now, the load to truck ratio is at all-time highs. There's about 12 loads for every available truck in the United States.
Wow.
And part of that's because drivers are also getting sick and going to quarantine. And so, a lot of trucking companies are seeing their absenteeism surge. And so that's part of it, but part of it is the demand side. We're just still trying to move a record number of products around the country. So it's going to take us a while to really filter through all of this and to see the supply chain really start to smooth out.
Gotcha. Well, let's take a look at the long-term run on this. And we talked about a flattening. You can kind of long-term, you can kind of see that wallowing out, if you will, that trough starting to be created. Not unprecedented, though. I'll point out, though, if you take a look back in history, all the way back in 2000, 2001, you had a pretty deeper trough, and then other periods of time you have troughs. So, but it seems to be, when you look at that long-term trend line, not too far off of what you'd expect trend-wise.
Absolutely. Yeah. And look at that, like November 2013 through, June of 2014. I mean, almost the same curve. And then you get the same repeat pattern kind of in 2017, 2018. So, now it'll be interesting to see what happens in the models as we move forward and it starts to predict more of 2023. Yeah, no, it feels like a great curve. And I love this view because you can see that we really are talking about a growing sector. So industrial production and manufacturing is going to grow, which means transportation demand is going to grow. There's just a lot of industries that really feed off of this. And so it's a positive story, probably more positive than the first slide we showed everyone.
Sure. And then this is the year over year. And I'll point out that the dashed line, the red dashed line shows you the projection. You can see the tail end. In dark blue, you see 2021 here. And then as you get to the end of 2021, you get the last bit of projection, which is November, December, the numbers that we're looking at. But then you can see that the 2022 forecast right here through the middle is pretty consistent with what we've seen in the past. And in fact, it looks awfully similar to 2019's run.
Yeah, I like it. And I like what you've done with it here. I would imagine too, if we see the supply chain start to smooth out a little bit once we get kind of into January and February, or the end of January and into February, that 2022 curve could start to mirror a little more of like what we saw in 2018. There's still a lot of catch up to do. And unless the economy really falls off a cliff, and it would only do that because of inflationary pressure. We've still got a record number of job openings. The job market is strong. Wages are strong. There's nothing that would send the consumer into a tailspin except for the inflationary pressure that we see. So if inflation starts to ease a little bit, then I do think that dotted 2022 line starts to trend a little bit closer to 2018. So, and at worst, what we're projecting is that it's going to feel average, right? So it's still growth.
Sure.
It's just an average growth rate. So.
Sure. Okay. Well, thanks, Keith, for that. And we will get on to our subsectors now. For those of you who are members, just make sure you log in and get into the subsectors where we'll talk about aerospace, motor vehicles, primary metals, fabricated metals, computer and electronic parts, and the electrical equipment sectors. Okay.
Thank you. And if you're not a member, check out the free trial. It's super easy to get, and test drive it and kick the tires for a month or so.
Okay.
Thanks, everybody.
All right. Thank you.
Take care.